This is part 1 of the presentation for Module 7 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In Module 7, we will analyze quantitative and qualitative aspects of liability financing. The analysis of current liabilities will include both accrued, deferred, and contingent liabilities, such as warranties and short-term and current maturities of long-term debt. Long-term liability analysis will include bond pricing, the effective cost of debt, footnote disclosure, financial effects of bond repurchases, and fair value disclosures. Credit quality and ratings will be covered, including the determinants of credit quality and how credit ratings influence the effective cost of debt and investment and non-investment grade credit ratings. In this learning objective, we will analyze accrued liabilities. The current liabilities section of the balance sheet reports liabilities that will normally mature within 1 year from the balance sheet date. The information that Verizon Communications provides for current liabilities in the 2018 annual report and footnotes are shown on this slide. The total current liabilities of $37,930 million includes the usual categories of debt maturing within 1 year and shorter debt. This category typically includes non-operating liabilities such as loans from banks, commercial paper borrowings, and scheduled maturities of long-term bonds and notes. Also shown are operating liabilities such as accounts payable, which are the amounts owed to suppliers for purchases of goods and services on account, and accrued liabilities, which typically include many different accruals such as unpaid salaries and wages, interest and taxes, customer deposits, and dividends payable to shareholders. Accrued liabilities are adjustments that accountants make to the balance sheet after all transactions have been entered into the accounting records and prior to the issuance of the financial statements, so that those statements fairly present the financial condition of the company. These adjustments recognize liabilities on the balance sheet and the related expenses on the income statement that are not the result of external transactions such as the purchase of goods or services on account recognized as accounts payable. Accrued liabilities are incurred in the current period and therefore must be recognized in it. There are two broad categories of accrued liabilities. The first are accruals for routine contractual liabilities such as wages that the company is contractually obligated to pay to employees for work performed but not yet paid in the current period. Also, interest that is due in the current period on borrowed money that has not been paid, and income taxes that are owed as a result of profit earned during the period, as well as other operating liabilities that have been incurred but not paid for, such as rent, utilities, etc. Other accruals are for contingent liabilities. Contingent liabilities depend on the occurrence of a future uncertain event in order to determine whether a liability exists, and if so, at what amount. Examples include litigation brought against a company or warranty liabilities for products sold, the amount of which depends upon the occurrence of product defects that require the company to repair or replace the product purchased. Many companies pay employees bi-monthly. In the last 2 weeks of the month, employees have worked for the company and earned wages but have not yet been paid. If the liability for unpaid wages is not reflected on the month-end balance sheet, liabilities will be understated and wage expense will not be reflected in the income statement, thus overstating profit for the period. To correct this, accountants make an entry to reflect the unpaid wage liability on the balance sheet and recognize wage expense in the income statement. When the wages are subsequently paid in the following month, cash decreases, as does the wage liability. Deferred or unearned revenue represents deposits or other repayments from customers that the company has not yet earned. Verizon collects cash in advance from customers who opt for prepaid phone plans that enable customers to obtain wireless services without credit verification by paying for all services in advance. Verizon also collects deposits from commercial customers in advance of major installations of communication equipment. Both types of prepayments are deferred revenue until Verizon provides the related services, that is, until the prepaid plan is used or the installation is completed. Some accrued liabilities are less certain than others because the ultimate settlement of the liability is contingent on the outcome of some future event. Companies must record an accrual when two conditions are met. First, it must be probable that one or more future events will confirm that a liability existed on the balance sheet date. Second, the amount required to settle the liability in the future can be reasonably determined at the financial statement date. The amount recorded should be the best estimate of the future expenditure required to settle the obligation. Warranty liabilities are commitments that manufacturers make to their customers to repair or replace defective products within a specified period of time. If the obligation is probable and the amount estimable with reasonable certainty, GAAP requires manufacturers to record the expected cost of warranties as a liability and to record the related expected warranty expense in the income statement in the same period that the sales revenue is reported. When the defective product is later replaced or repaired, the liability is reduced together with the cost of the inventory, cash paid for labor to repair the product, parts used in the repair, and any other costs that were necessary to satisfy the claim. Harley-Davidson's warranty footnote in its 2018 annual report included a reserve at the beginning of 2018 for $94,200 for estimated product warranty and safety recall costs. During 2018, the company added $53,367 to the reserve relating to warranties on products sold in 2018. Then the company added another $63,473 to update the estimates it made in prior periods because the actual cost to replace and repair recalled equipment came in significantly higher than anticipated and the company needed a catch-up accrual. During 2018, the company paid $79,300 to settle warranty claims. The settlement included cash paid to customers for refunds, wages paid to employees who repair the motorcycles, and the cost of parts used in repairs. It is important to understand that only the increase in the liability impacts the income statement. The accrual of $116,840 recorded as warranty expense, which reduces pre-tax income. Payments made to settle warranty claims do not affect current period income, they only reduce the pre-existing liability. GAAP requires that the warranty liability reflect the estimated costs that the company expects to incur as a result of warranty claims. This is often a difficult estimate to make and is prone to error. Each period, the company examines the liability and updates the amount to reflect new, more accurate information, as we saw for Harley-Davidson. There is also the possibility that a company might intentionally underestimate a warranty liability to report higher current net income or overestimate it to depress current income and create an additional liability on the balance sheet that can be used to absorb future warranty costs and reduce future expenses. The overestimation would shift income from the current period to one or more future periods. Warranty liabilities must therefore be examined closely and compared with sales levels. Any deviations from the historical relationship of the warranty liability to sales or from levels reported by competitors should be scrutinized. Returning to the Harley-Davidson information, assume that the analyst wishes to adjust the estimated warranty and recall liability so that its percentage is consistent across periods. To illustrate, we consider the recent 3 years of data from Harley-Davidson. One approach to the warranty expense is to determine the average percentage from 2016 to 2018. In this way, the analyst can undo potential earnings management in the event that Harley-Davidson was intentionally underestimating warranty expenses in the 2016 and 2017 periods to achieve desired financial reporting outcomes. To reformulate the warranty expenses, we could add the amounts reported for 2016 to 2018 and divide the amounts by revenues for the same period. This calculation, as shown on the slide, yields an average of 1.83505%. To adjust the income statement, we adjust warranty expense and the tax expense, which affects net income. When warranty expense increases, pre-tax income is lower and therefore the tax expense decreases. This is the case for 2016 and 2017. In 2018, the opposite occurs. Warranty expense decreases, thereby increasing tax expense. The adjustment to the income statements are shown on this slide, assuming a 22% tax rate. We would also adjust the balance sheet to reflect the income statement adjustments. Changes in warranty expense affect the warranty liability dollar for dollar. In 2016 and 2017, we increased the warranty liability and deferred income tax assets and decreased retained earnings. The 2018 balance sheet does not require adjustment since the cumulative effects are already included in the accounts. In this learning objective, we will analyze short-term debt and current maturities of long-term debt. Companies generally seek to match the maturity of borrowings with the assets that they are financing. While property, plant, and equipment assets are appropriately financed with long-term debt and or equity, seasonal swings in working capital are often financed with a bank line of credit. In this case, the bank commits to lend up to a maximum amount with the understanding that the amounts borrowed will be repaid in full sometime during the year. An interest-bearing note evidences such borrowing. When the company borrows these short-term funds, it reports the cash received on the balance sheet together with an increase in liabilities. The note is reported as a current liability because the company expects to repay it within a year. Although this borrowing has no effect on income or equity, the borrower incurs interest on the note as time passes. GAAP requires the borrower to accrue the interest liability and the related interest expense each time the financial statements are issued. To illustrate accounting for short-term borrowing, we will assume that Verizon borrows $1,000 cash on January 1st. The note bears interest at a 12% annual rate, and the interest is payable on the first day of each subsequent quarter. Assuming Verizon issues quarterly financial statements, the borrowing results in an accrual of interest expense of $30 equal to the principal of $1,000 times the annual rate of 12% multiplied by 3 divided by 12 for the months of January, February, and March. The January 1st borrowing increases both cash and notes payable. On March 31st, Verizon issues its quarterly financial statements. Although interest is not paid until April 1, the company has incurred 3 months' interest obligation as of March 31st. Failure to recognize this liability and the expense incurred would not fairly present the financial condition of the company. The subsequent payment on April 1st reduces both cash and the interest payable that Verizon accrued on March 31st. Principal payments that must be made during the upcoming 12 months on long-term debt, such as for mortgages or maturing bonds, are reported as current liabilities, called current maturities of long-term debt. The current liabilities section of Verizon's 2018 balance sheet includes $7,190 million of debt maturing in 1 year. Some long-term debt, including mortgages, require a periodic payment that is part principal and part interest. Note that the current maturity is the principal portion of the payments that will be made in the upcoming year. Consider a 5-year 4% mortgage of $1 million that requires annual payments of $224,627. We can use a loan amortization schedule such as the one on this slide to determine the principal amount outstanding at each reporting period. In the first year, the amount of interest accrued on the loan is $40,000, calculated at 4% of $1 million. The remainder of the payment is a reduction of the principal amount of the loan. On the day the mortgage was taken out, the balance sheet would show a current maturity of $184,627, with the remainder $815,373 included in long-term debt. As the balance owed decreases, so too does the interest, and the current portion increases each year. In this learning objective, we will analyze long-term debt pricing. Companies often include long-term non-operating liabilities in their capital structure to fund long-term assets. Smaller amounts of long-term debt can be readily obtained from banks, private placement with insurance companies, and other credit sources. However, when a large amount of financing is required, the issuance of bonds and notes in capital markets is a cost-efficient way to raise funds. Bonds are structured like any other borrowing. The borrower receives cash and agrees to pay it back with interest. Generally, the entire face amount or principal of the bonds is repaid at maturity, the end of the bond's life, and interest payments are made in the interim, usually semi-annually. Companies that raise funds in the bond markets normally work with an underwriter such as Goldman Sachs to set the terms of the bond issue. The underwriter then sells individual bonds, usually in $1,000 denominations, from this general bond issue to their retail clients and professional portfolio managers such as the Vanguard Group, and receives a fee for underwriting the bond issue. The bonds are investments for individual investors, other companies, retirement plans, and insurance companies. After they are issued, the bonds can trade in the secondary market just like stocks. Market prices of bonds fluctuate daily despite the fact that companies' obligations for payment of principal and interest normally remain fixed throughout the life of the bonds. The bond's fixed rate of interest can be higher or lower than the interest rates offered on other securities of similar risk. Because bonds compete with other possible investments, bond prices are set relative to the prices of other investments. In a competitive investment market, a particular bond will become more or less desirable depending on the general level of interest rates offered by competing securities. Just as for any item, competitive pressures can cause bond prices to rise and fall. Before we discuss the mechanics of long-term debt pricing, we need to define two types of interest rates. First, there is the coupon rate, which can be referred to as the contract or stated rate. The coupon rate of interest is stated in the bond contract. It is used to compute the dollar amount of interest payments that are paid in cash to bondholders during the life of the bond issue. Second, there is the market rate, which can be called the yield or effective rate. This is the interest rate that investors expect to earn on the investment in the debt security and is the rate used to price the bond. The coupon rate and the market rate are nearly always different. This is because the coupon rate is fixed prior to the issuance of the bond and normally remains fixed throughout its life. Market rates of interest, on the other hand, fluctuate continually with the supply and demand for bonds in the marketplace, general macroeconomic conditions, and the borrower's financial condition. The bond price, both its initial sales price and the price it trades at in the secondary market subsequent to issuance, equals the present value of the expected future cash flows to the bondholders. Specifically, bondholders expect to receive two different types of cash flows. First, they expect periodic interest payments, usually semi-annually during the bond's life. These payments are called an annuity because they were equal in amount and made at regular intervals. Second, the bondholders expect to receive the single payment of the face or principal amount of the bonds at maturity. The single payment is a lump sum because it only occurs once. The bond price equals the present value of its periodic interest payments plus the present value of the single payment. The present value of the future payments determines the amount that the seller receives. If the coupon and market rates are the same, then the bonds will be issued at par. To illustrate the issuance, we assume a bond with a face amount of $10 million that has a 6% annual coupon rate payable semi-annually and a maturity of 10 years. The semi-annual rate is 3%, which is the annual rate divided by 2, and the number of interest payments is 20, which is 10 years multiplied by 2. Investors purchasing these bonds receive the cash flows shown on the slide, $300,000 of semi-annual interest payments and $10 million principal at maturity. If the market rate is also 6% or 3% semi-annually, the bonds will be issued at face or par, which is $10 million. To calculate that, we would first determine the present value factors for the interest and principal payments using 3% interest and 20 periods, and then multiply the interest payments and principal by the factors. The sum of the present values of the semi-annual interest payments and principal are $10 million as shown. You can find the present value factors in Appendix A to your textbook. You can also determine present value with the financial calculator or in Excel as shown in the appendix to Chapter 7. To illustrate the pricing of bonds at a discount, we will use the same example but change the market or effective rate to 4%. When the coupon rate is lower than the market rate, the bonds will be issued at a discount because the investors demand a higher rate than the bonds offer. Using the same procedure as before, we would determine the present value factors for a 4% semi-annual rate and 20 periods and multiply the factors by the semi-annual interest payment of $300,000 and the principal of $10 million as shown on the slide. The present value is $8,640,999 and the discount is the difference between the face or maturity amount of the bonds, $10 million, and the present value or $1,359,001. The amount will be amortized to interest expense over the life of the bond so that the interest expense will equal 4%, the market or effective rate. To illustrate the issuance of the bonds at a premium, we will assume that the market or effective rate is 2% semi-annually. Since the bonds carry a higher coupon rate of 3% semi-annually, the bonds will sell at an amount greater than the face or maturity amount. We would calculate the bond proceeds using the same procedures, but we would use 2% and 20 periods to determine the present value factors. Multiplying these factors times the $300,000 semi-annual interest payments and the $10 million principal amount, we would determine the bond proceeds to be $11,635,129. The difference between the proceeds and the face or maturity amount of $10 million would yield a premium of $1,635,129, which would be amortized to interest expense over the life of the bonds to reduce the interest expense to 2% semi-annually, the market rate. The effective rate of a bond always equals the yield or market rate demanded by investors, regardless of the coupon rate of the bond. This means that companies cannot influence the effective cost of debt by raising or lowering the coupon rate. Doing so will only result in a bond premium or discount. The effective cost of debt is reflected in the amount of interest expense reported in the issuer's income statement. Because of bond discounts and premiums, interest expense is usually different from the cash interest paid. In this learning objective, we will analyze long-term debt. Companies typically have many debt issues outstanding and disclose the total amount as a long-term liability on the balance sheet. Footnotes provide details about each of the company's outstanding bonds and notes like the one shown on this slide for Verizon. In general, companies report debt net of any discount or including any premium, and also net of any debt issuance cost. Verizon subtracted unamortized discount net of premium of $6,298 million and unamortized debt issuance cost of $541 million to arrive at total long-term debt, including current maturities of $112,913 million in 2018. Then Verizon subtracted $7,040 million, the amount of the debt that matures in the next year, to arrive at the $105,873 million that is reported in the non-current liability section of the 2018 balance sheet. Companies must provide a schedule of the maturities of their long-term debt in the footnotes to the financial statements as shown on this slide for Verizon's 2018 annual report. In general, we look for significant amounts maturing in any one year, as this raises the question whether the company will have the cash flow to make the required payment. We prefer to see a relatively level debt repayment schedule like the one for Verizon, which allows for an orderly payment of refinancing. To assess whether these amounts are large, consider that Verizon's operating cash flow for 2018 is $34,339 million. So while the amounts of maturing debt are not insignificant, they should be manageable for Verizon. The size of Verizon's total debt, however, is one reason why the company's credit rating is not high. Between the bond issuance and maturity, the discount in debt issuance cost must decline to zero. This reduction is called amortization, and the discount amortization results in additional interest expense in the income statement. Thus, the amortization causes the total interest expense to be greater than the cash interest payments for a discount, and the opposite is true for bonds and notes issued at a premium. The total interest expense is less than the cash interest paid. Consequently, the interest expense on the income statement each year represents the effective cost of debt, including both the cash interest paid plus a portion of the additional borrowing cost, or less a portion of the benefit of a premium. Companies report bonds payable at historical adjusted costs. Specifically, net bonds payable amounts follow the amortization schedule, as do the related cash flows and income statement numbers. All financial statement relationships are set when the bonds are issued and do not change after that. Once issued, however, the bonds trade in secondary markets. The yield rate used to compute bond prices for these subsequent transactions is the market interest rate prevailing at the time. These rates change daily based on the level of interest rates in the economy and the perceived creditworthiness of the bond issuer. Companies can and do repurchase or redeem or retire their bonds prior to maturity. The bond indenture can include provisions giving the company the right to repurchase its bonds directly from the bondholders, or the company can repurchase bonds in the open market. When a bond repurchase occurs, a gain or loss usually results and is computed as the net bonds payable minus the repurchase payment. The net bonds payable, also referred to as the bond value, is the net amount reported on the balance sheet. If the issuer pays more to retire the bonds than the amount carried on its balance sheet, it reports a loss on its income statement, usually called loss on bond retirement. The issuer reports a gain on bond retirement if the repurchase price is less than the net bonds payable. There are no economic effects of the early retirement of bonds because the gain or loss on repurchase is exactly offset by the present value of the future cash flow implications of the repurchase. The gain or loss on early retirement is a transitory item and consequently will not be reported on future income statements. An important analysis issue involves assessing the fair value of bonds and other long-term liabilities. This information is relevant for investors and creditors because it reveals unrealized gains and losses similar to that reported for marketable securities. GAAP requires companies to provide information about current fair values of their long-term liabilities in footnotes such as the one shown for Verizon in its 2018 10-K. The increase in fair value is due to a decline in market rates of interest since the debt was initially issued, or to an increase in the credit rating of the company. These fair values are not reported on the balance sheet, and changes in these fair values are not reflected in net income. The chief justification for not recognizing fair value gains and losses is that such amounts can reverse with subsequent fluctuations in market rates of interest, and the bonds are repaid at par at maturity. This is the end of Part 1 of the presentation for Module 7 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.